I'm seeing article after article in the general news and in the financial news trash talking what's known as the traditional balanced portfolio, which is roughly 60% stocks, 40% bonds, 70-30, 80-20, depending on your age, your situation, how much risk you're willing to take. Well, the last few years have been the worst years for doing this type of portfolio where you do a mix of stock funds and bond funds in pretty much history. And so I'm reading all these stories with headlines about how bonds no longer play any role in your life. You should never buy bonds. You're much better off buying CDs or having money in savings accounts for the portion you wouldn't have invested in stock type choices. And they go on and on and on about why anybody who would put money in bond funds is basically an idiot. And this is so crazy because this is what's known in both behavioral economics and human behavior as recency bias. Whatever has happened of late, we take that and we think, oh, that's what it's going to be moving forward. Whatever's happened just recently means if you look into the future, well, that's what's going to happen again. And any financial document you'll see, if you ever look at the disclosures, it'll always say when it's about a fund, past performance is no indicator of future performance. And that applies here too. There are very solid reasons why you want to be an investor and you want to be a lender. When you own bond funds, you are a lender. You are lending money to government at all levels or companies, various forms of where people say, okay, we're gonna borrow money from you. You're the bank, essentially. When you own bond funds, we're going to lend you money, and this is how much interest we expect from you. So this is something that has served people well for generations till pretty much the last 3 years. Why did it do so badly the last 3 years? Because we had suppressed interest rates ever since the banking scandals that blew up on the economy in 2007-8 and caused the Great Recession and all that. So we'd had these weirdly low mortgage rates and other interest rates, and savers couldn't earn anything. And so when interest rates started going up and getting what would be referred to as normalized, the value of bonds that people held went down. Why'd they go down? When interest rates go up, the value of existing bonds goes down. Because if you want somebody to buy that bond from you, they're going to want today's equivalent interest rate if they're going to take over that bond, that loan from you. So the bond market just got decimated as the Federal Reserve and the economy in general pushed interest rates up over the last few years. And so suddenly people decided that the stove was too hot. They had to get out of the kitchen and forever never own bonds again. This is a big mistake because interest rates seem to be pretty much near their peak. There may be a little more bump up, but likely we're near the end. And so now you've got bonds that if they're part of your portfolio are going to give you a much better return in interest than they have in recent years, where you're going to charge people to lend them money, charge government or charge business when you own bonds, is going to be at a higher rate. And so this is not a time to throw out the balanced portfolio or the mix of owning stock funds, index funds, ETFs, and owning bonds. So yeah, it was really ugly the last 3 years. But that doesn't in any way mean that what has worked for generations is never going to work again. It's actually the opposite. Just because things were bad the last few years doesn't mean you bail, throw it out moving forward. Because that, if I use another trite phrase, that's like throwing the baby out with the bathwater. Don't do it.